In the dynamic world of trading, there's an age-old battle between two approaches: price action and indicators. While indicators certainly have their place in the trader's toolkit, it's essential to understand why price action consistently emerges as the preferred method for many successful traders. The key lies in the context, something that indicators often overlook. Indicators, as valuable as they can be, lack the depth of understanding that price action brings to the table. They may offer insights into momentum, trend strength, and potential reversal points, but they miss the crucial context behind those price movements. Price action, on the other hand, is all about understanding the story behind each candlestick, each swing, and each pivot. Indicators don't possess the ability to comprehend the psychology of market participants. They don't know about past price levels where traders had shown significant interest. Price action, on the other hand, takes a deep dive into this collective behavior, revealing the patterns that market participants tend to repeat. Price action considers where the price is coming from, whether it's breaking through a significant resistance level or bouncing off a reliable support zone. It recognizes the journey of the price, how far it has risen or fallen, and how long it has held within a specific range. This context is essential because the market is full of patterns that tend to repeat, offering valuable clues to traders. Support and resistance levels, key components of price action, work remarkably well because they reflect past price levels where market participants showed interest. These levels act as psychological markers, revealing the collective sentiment of traders at those particular price points. Trend lines, another essential aspect of price action, provide insights into the market's overall direction and the balance between buyers and sellers. These critical components of price action analysis are like road signs on a trader's journey. They represent historical zones where buying or selling pressure was notably strong. Market participants remember these levels, and when price revisits them, a multitude of traders react, leading to potential reversals or bounces. Unlike indicators, price action enthusiasts understand the significance of history in trading. They appreciate the fact that market behavior often repeats itself. By observing past price levels and the behaviors of market participants at those levels, price action traders gain a unique advantage. They can spot potential turning points, identify areas of accumulation or distribution, and anticipate breakouts or reversals more effectively. The beauty of price action lies in its simplicity. It doesn't rely on complicated formulas or mathematical calculations. Instead, it relies on the natural ebb and flow of the market, the way traders react to price levels, and the patterns that emerge from this collective behavior. In the ongoing debate of price action versus indicators, price action emerges as the champion because it recognizes that in the market, history often repeats itself, and those who understand this concept can make more informed, strategic, and ultimately profitable trading decisions. So, if you're looking to elevate your trading game, consider embracing the power of price action. It's a timeless tool that stands the test of time in the ever-changing world of finance. Please like the video if you enjoyed it and subscribe to the channel for more such videos. Thanks for watching, and I will see you in the next one.